Okay, let's dive right into this. Welcome back to Iron Financial. This is the explainer where we completely strip away the market noise, we relentlessly inspect the structural integrity of the balance sheets, and we help you forge a stronger, much more resilient portfolio. I'm your lead analyst, and today we are putting the world's absolute most talked about biopharmaceutical giant squarely under the microscope. We're talking about Pfizer. We are looking directly at their Q1 2026 earnings report and that massive R&D pipeline update they just dropped on May 5th. Look, right now there is just a tremendous amount of fear out there on the street. The market has literally been treating this stock like a dilapidated teardown ever since those massive pandemic revenues dried up. Institutional investors, they're panicked about the loss of that historical top-line revenue. And retail investors are just abandoning ship because the easy momentum is completely gone. But you know what? My job isn't to trade on emotion. My job is to look at the cold, hard math. The revenue, the debt, the margins, and the numbers from Q1 2026 are telling a very, very specific story. So the core question we absolutely have to answer today is simple. Are these latest earnings showing us a solid, concrete foundation being forged for the next decade of growth? Or is this current market weakness just exposing a classic value trap?
And honestly, that is exactly what the audience wants to know today. I'm stepping in as the market skeptic because let's be real for a second. The post-COVID recovery narrative surrounding this pharma giant has been aggressively pushed by management for years now. And investors are absolutely fatigued. We're exhausted. The stock has essentially been trading sideways or just slowly bleeding downward while the broader market rallies. So patience is running incredibly thin. We really need to know, is this actual durability we are looking at? Are we finally seeing a return to core operational strength, or is this just more slick market hype designed to keep shareholders from running for the exits? We need pure clarity today. We need to know if this stock is fundamentally sound from the ground up. Let's look at the strict inspection blueprint for this explainer so we know exactly what we're tackling.
All right, here is our blueprint for today. Section 1, the foundation, Q1 earnings. Section 2, load-bearing walls, top sellers. Section 3, cracks in the armor, the COVID cliff. Section 4, blueprints, the R&D pipeline. And finally, Section 5, the verdict.
Let's get right into Section 1, the foundation, Q1 2026 earnings breakdown.
Okay, let's see exactly how this whole thing builds out. We have to start right at bedrock. If you ever want to know if a company can truly survive massive macroeconomic headwinds, you look directly at its most recent quarterly performance. So, we are going to run through a rapid-fire assessment of the Q1 2026 metrics that management just released. Now, pay close attention to the operational growth versus the reported growth, because I promise you, that is where the structural truth really lies. Top-line revenue for the first quarter came in at an absolutely massive $14.45 billion. That represents a 5% year-over-year reported growth. Now think about this. For a company of Pfizer's immense global scale, adding a 5% top-line increase in a single quarter is like a massive pour of fresh concrete right into the foundation. It shows that despite all the macro noise, the global biopharmaceuticals business, which, by the way, generated $14.1 billion of that total, is actively expanding its footprint. But here is the catch. That reported revenue includes a $431 million favorable impact just from foreign exchange rates. As analysts, we always want to strip that noise away. By removing those unpredictable currency fluctuations, we get a much truer, completely unvarnished picture of the organic, structural strength of the actual business.
Now look at this, 22%. This is the metric that literally jumped right off the page during our inspection. This brilliantly illustrates that organic strength we were just talking about. 22% operational revenue growth specifically coming from launched and acquired products. Guys, this is a massive steel pillar of structural strength. This isn't just their old legacy products slowly ticking up by 1% or 2%. This is the new steel going into the building. Remember when management deployed major capital to acquire companies like Seagen, that leading oncology specialist? The broader market heavily questioned if they overpaid for that asset. Well, a 22% operational growth rate in this newly acquired and launched portfolio completely proves that those acquisitions are already generating heavy load-bearing cash flow. It completely validates their underlying M&A strategy.
Wrapping up this rapid data drop, we absolutely have to look at the bottom line. Adjusted diluted earnings per share came in at $0.75, backed by a staggering adjusted income of $4.29 billion for the quarter. While the reported EPS was technically $0.47, that adjusted $0.75 EPS proves that bottom-line profitability remains totally fundamentally intact. Breaking down that $4.29 billion in adjusted income means they have immense self-funding capabilities. This is absolutely crucial. They don't have to go out and beg the debt markets for cash at today's high interest rates just to fund their research. They are generating serious, reliable operational cash flow right now, today. They aren't just buying revenue at the expense of their margins, they are incredibly efficiently converting that massive $14.45 billion top line into real distributable earnings that they can deploy to fortify the business.
Okay, hold on. I have to interrupt this rapid-fire numbers celebration for a second to probe a very well-known, glaring weak point. Are we just going to completely ignore the expected $1.5 billion revenue drag? Management themselves literally admitted in their own guidance that they anticipate a massive $1.5 billion hit due to recent and upcoming generic and biosimilar competition in 2026. $1.5 billion just evaporating into thin air is catastrophic. You simply can't forge a strong portfolio if the floor is literally about to drop out from underneath your legacy patents. How does this supposed foundation hold up to a stress fracture of that magnitude?
Honestly, that is a completely fair point to make. But here's the thing. You counter stress fractures with aggressive structural reinforcement, and Pfizer's capital allocation strategy is doing exactly that. Look at the moves they are making. During the first 3 months of 2026 alone, they returned $2.4 billion directly to shareholders in pure cash dividends. But more importantly, focus your attention on that $3.3 billion figure still remaining in their share repurchase authorization. Now, while current guidance doesn't actually anticipate them executing repurchases in 2026, keeping $3.3 billion locked and loaded in the chamber is a massive shock absorber for the stock price. Combine that financial cushion with the $2.5 billion they aggressively reinvested into internal R&D just this past quarter, and what you see is a management team that is actively, deliberately outbuilding the patent cliff using pure financial muscle.
Moving right along to Section 2, Load-Bearing Walls 2025 Top Medicines. So the truly crucial point here is understanding exactly what products are generating the cash to actually fund this massive defense. We need to examine the specific underlying assets that are doing all the heavy lifting. To do that, we are pulling the full year data from their 2025 annual review to identify the true load-bearing walls of this portfolio. Just look at the sheer, undeniable scale of these top 3 medicines from 2025. Eliquis, which is an absolutely market-dominating blood thinner, generated nearly $8 billion, $7,961 million to be exact. Then you have the Prevnar family, which are their foundational pneumococcal vaccines. That brought in almost $6.5 billion. And the Vindigal family, which treats very specific rare heart diseases, contributed over $6.3 billion. Together, just these 3 mega blockbusters alone represent over $20 billion in highly reliable recurring revenue. These act as the primary load-bearing walls of the entire corporate enterprise. Reminding ourselves of their sheer market dominance completely proves that as long as these core assets remain structurally sound, Pfizer has the balance sheet flexibility to weather almost any storm that hits their experimental pipelines. But listen, a strong portfolio isn't just about maintaining the legacy walls, it's entirely about the new reinforcement beams being installed right now. If we drill deeper into the Q1 2026 operational growth data, the numbers are just exceptional. Oncology biosimilars are up an astonishing 52%. Nurtec, ODT, and Vidura are up 41%. And Padcev, which is a highly crucial targeted piece of their whole oncology strategy, is up 39%. You have to understand, these aren't low-margin generic fillers. These are high-growth, highly specialized therapeutics that are rapidly reinforcing the overall revenue structure. In fact, to truly optimize this precise performance, Pfizer just went ahead and created a brand new global hospital and biosimilars division. Reorganizing the entire workforce around these specific structural assets is a brilliantly tactical management move, ensuring they get the absolute maximum structural yield from their fastest-growing therapies.
Let's hit Section 3, Cracks in the Armor, the COVID Cliff.
All right, look, let's stop looking at all the shiny new additions for a second and rigorously inspect the massive, glaring structural cracks in the armor. You know exactly what I'm talking about here, the COVID cliff. For the last few years, this company was practically printing money in the basement with vaccines and therapeutics. Now, the pandemic is officially in the rearview mirror, and those revenue streams are rapidly evaporating. I need you to transparently detail exactly how bad the bleeding is here, because to the average retail investor looking at this stock, this looks like a catastrophic failure of the business model. I concede the point entirely. You are absolutely right. We cannot honestly evaluate this foundation without staring directly, unflinchingly at the COVID drag. And the numbers here are frankly severe. In Q1 2026, Comirnaty revenues fell 59% operationally. Paxlovid fell a staggering 63% operationally. And the drivers are exactly what you'd logically expect: drastically lower utilization globally and a steep drop in massive government bulk purchases. This was a temporary scaffolding that was built incredibly fast during an unprecedented global crisis, and now that scaffolding is being aggressively dismantled. Losing over half the revenue on your absolute top-selling historical products is an incredibly jarring drop, and there's no denying it actively pulls down the bottom line, dragging the overall top-line performance right into the mud.
But, and this is a massive but, this is exactly where professional analysts separate the signal from the noise. We have to isolate the data to make a truly accurate evaluation of the core business. If you look at the total business, including those falling COVID products, operational growth is just 2%. It looks utterly, painfully stagnant. But wait until you see this. When we finally stripped away the COVID noise entirely, when you completely remove Comirnaty and Paxlovid from the equation, this underlying 7% organic growth revealed itself. 7% organic growth on a base business this massive is an incredibly strong revelation. It fundamentally proves that the non-COVID business isn't just surviving the teardown of the temporary scaffolding, it is actively, aggressively expanding on its own merits.
Section 4. Blueprints, the R&D pipeline. Now that we've firmly verified that the current foundation actually holds, our inspection has to move to the future blueprints. Let's be real, a biopharma company is only as valuable as its clinical pipeline. So we're going to unpack the comprehensive May 5, 2026 R&D pipeline update to see exactly what management is actively building for the next decade.
Okay, but is this R&D pipeline actually viable? Because everyone promises future breakthroughs, right? But R&D is a notorious, bottomless money pit in this sector. Are they just throwing cash at a wall hoping something sticks? Or is there a highly targeted, high-probability construction plan here? It is incredibly targeted. CEO Albert Bourla stated explicitly in the Q1 report that they are seeing highly encouraging mid-stage results and positive phase 3 readouts, specifically citing meaningful momentum in oncology and obesity. Look, these are arguably the two most lucrative, highest-demand therapeutic areas in global medicine right now. Oncology treatments command the absolute highest pricing power, and obesity drugs are simply the single fastest-growing consumer health segment in medical history. They are directly aiming to be market leaders in the exact spaces that command the absolute highest premiums.
And guys, the sheer volume of this blueprint is just staggering. As of May 5th, 2026, they have 102 active R&D projects. But don't just look at the total number, look at the distribution. 38 in Phase 1, 30 in Phase 2, and a massive, heavy concentration of 32 different projects currently sitting in Phase 3, with 2 more already in the registration phase. Phase 3 is where the concrete is actually poured. These are late-stage assets nearing real-world commercialization. Having this heavy of a concentration in Phase 3 is a massive de-risking factor for investors. This isn't just a pipeline stuffed with early-stage, speculative science that might fail in a year. This is a highly mature pipeline completely prepped for significant near-term market delivery. In fact, 10 distinct programs advanced or were newly added just since their last update. The momentum is real.
Let's walk through the absolutely critical catalyst for 2026 that will act as the key structural milestones for this stock. First up, regulatory decisions are expected for Pavzi, which is targeting hemophilia A and B. Second, we have massive market-moving data readouts coming for Padcev and muscle-invasive bladder cancer. And remember what we said earlier. Padcev is already growing at 39%. Expanding its clinical indications is literally like adding another high-rent floor to an already profitable skyscraper. Finally, we are closely watching the pivotal study start, specifically the Phase 2b study for berobenatide. This is their once-monthly chronic weight management drug. This is their direct, aggressive entry into the booming obesity market. When you frame that against the broader market craze for GLP-1 drugs, you instantly understand why this specific blueprint matters so much to the stock's future valuation.
To truly reinforce the sheer scale of the upcoming construction, we look directly at management's own commitment. They explicitly stated in the Q1 report that they are, quote, on track to start approximately 20 key pivotal studies in 2026. Now, really think about the sheer logistical and financial heavy lifting required to run 20 pivotal, late-stage studies simultaneously across the globe. You absolutely do not initiate a build-out of that magnitude in a single calendar year if your balance sheet is weak or if your underlying science is failing. That requires billions in allocated capital and supreme, unwavering confidence in the clinical data. This is an aggressive, multi-billion-dollar build-out phase, plain and simple.
Which brings us to Section 5, the verdict,
Opportunity or trap?
We've thoroughly inspected the bedrock, we've tested the load-bearing walls, we've accurately measured the cracks, and we've reviewed the future blueprints. Now it is time to bring all this financial and clinical data together to deliver our final authoritative, iron financial verdict on Pfizer's true durability. Look, the ultimate proof of structural integrity always comes from the architects themselves. Despite the massive COVID cliff and the impending patent expirations, management completely, 100%, reaffirmed their full-year 2026 guidance. They are confidently projecting revenues between $59.5 and $62.5 billion. They are standing perfectly firm on an adjusted diluted EPS of $2.80 to $3 per share. And crucially, they are forecasting $10.5 to $11.5 billion in adjusted R&D expenses. Slashing that R&D budget would be such an easy way to artificially boost today's earnings per share to appease Wall Street, but maintaining it proves they are entirely playing the long game. They are highly confident in the cash-generating power of this business for the rest of the year.
So here is the ultimate million-dollar question for anyone actively managing a portfolio right now. We see the solid structural growth of the core portfolio. We clearly see that 7% operational growth when you exclude the temporary COVID noise. But does that 7% growth truly outmuscle the known upcoming stress fractures like the $1.5 billion patent cliff? Is the new steel they are installing strong enough to support the sheer weight of the old walls coming down?
Here is the definitive iron financial verdict. The foundation holds. Yes, the COVID scaffolding is completely gone, and yes, generic competition will undoubtedly erode the older legacy assets. But the math just doesn't lie. The 22% growth in launched and acquired products is an explosive, undeniable structural win. High-margin oncology drugs are rapidly scaling, with biosimilars up 52% and PADCEV soaring 39%. And with a massive 102 project pipeline heavily weighted in late-stage Phase 3 trials, fully backed by an $11 billion R&D budget and a $3.3 billion share repurchase cushion, this is a remarkably solid build. The underlying 7% core growth proves this portfolio completely outmuscles the COVID drag. This is not a fundamentally flawed value trap, it is a fortress in transition, aggressively building its next iteration of growth.
But remember, a strong foundation is only the beginning. It's all about what you eventually build on top of it. As Pfizer successfully advances berobenatide into Phase 2b and aggressively targets the highly lucrative metabolic and weight management sectors, the upside potential of this stock shifts dramatically. So, I'm going to leave you with this final provocative thought. Look closely at your own investments. How much weight are you actively giving to this rapidly emerging obesity pipeline in your own portfolio construction? Are you positioning yourself right now for this structural transition, or are you still blinded by the COVID hangover? Because I guarantee you, if Pfizer executes on these blueprints, this stock won't be priced like a stagnant post-pandemic recovery play for much longer. Thanks for joining us on this explainer, and as always, keep building ironclad portfolios.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.